Hello everyone. Hopefully the audio is good on this one. I'm going to be walking through the Goldenrod Assignment Cash Flow 3 handout. And throughout, I'm going to go through each of the questions, talk about the answers, talk about some concepts. And the yellow blocks like this and the blue blocks like this are going to be scattered throughout, and they're things that we have to solve for or backed into. So it says that Pepper Company acquired 100% of Salt Company. It keeps going with more information. I'm not going to bore you reading it. You can read it on your own. Pause this if you need to. And then it gives us this information in the balance sheet. The first question is, what is the tax basis of the equipment on Pepper's books? So the basis for Pepper's books is 250. We get that from right up here. We bring it down to here. How do you get this adjustment to get to tax? Well, you know that you have a deferred tax liability of 15. That means that the deferred tax liability is 15, so the temporary difference would be whatever the DTL is divided by the tax rate. So 15 divided by 0.3, because the tax rate is 30%, will give us that $50. Now, why do you subtract it from 250 instead of add it? Well, if you remember what a DTL is, it is a deferred tax liability that comes from a taxable temporary difference, which means you can deduct it now and you will be taxed on it in the future. If you deducted it now, that means that the basis will be lower for tax. If this were a deferred tax asset, we would add it. But because it's a deferred tax liability, it's something that we got to deduct now and we'll have to pay taxes in the future. We will be liable in the future. We're deferring the tax liability, Jim Stice style. So that's how we get the 200 here. Question 2 is, what is the tax basis of the equipment on Salt's books? So $100 comes again from right up here, boom, and we're going to bring that down. The adjustment is $20. Why? DTL of 6 divided by 0.3 gives us 20. Again, DTL, we subtract it from the book basis to get 80, and that's what our tax basis is for Salt. We'll come back to those toward the end on the ending tab. Now, flipping the page, we're going to do the journal entries. So number 3 says, what are the journal entries that Pepper will record as a result of the acquisition? I have those typed out right over here, and we're going to walk through what they are. You have an investment of S for 420. How do you know that? Well, it says that they acquired it 100%, issuing 10 shares for $42 market value. So 10 times 42 is 420. $10 for common stock because they're 10 shares at $1 par value, and then the rest is the plug of APIC. Now this other part, whoops, let me highlight the whole thing. This other part is things that we have to remember anytime, because it says they paid $15 in stock issuance cost. Anytime you issue the stock and have to pay for it, you're going to take that right out of APIC. So 15, and part of this is the 15 from that. Then the expense, it says that there were other direct combination costs. So you just expense those off in the balance sheet. You expense those off on your income statement, and then you credit cash for that amount. So 15 and 10 right here come into that 25 for cash. That's just the basic journal entries that we do. And then the fourth question talks about the differential. So we need to figure out if there's goodwill or gain, and then figure out what the differential is, allocate it, and amortize it, and create a little schedule for it. So the purchase price is 420. Book value is 284. That's just summing up the assets minus the liabilities for their book value. And then the fair value of net identifiable assets is taking all of the fair value of the assets themselves minus the fair value of the liabilities. Now this is a problem. We don't know what the deferred tax liability is. It gives us all the other stuff, but we can figure this one out because in the problem it tells us that all of the DTL comes from one tax book difference, and that's depreciation. So we know that it has to do with equipment. If the book value is 100 and the tax basis is 80, then we know that that deferred tax liability was 6 because the $20 difference right here times 0.3 equals 6. Well, what if our actual value was 200? So 200 versus the 80 gives us a difference of 120. I don't have that typed anywhere, but just know that 200 minus 80 is 120. Multiply that by 0.3 and you get 36. And because this is completely associated with equipment that is 5 years, you also have 5 years here. So that's how you figure that part out. And then the fair value of the net identifiable assets, should be the sum of these minus the sum of those, and that gives us 354. To figure out the goodwill or the gain, you do the purchase price minus the fair value of net identifiable assets. So I'm going to do that minus that. And that gives me 66. So I have goodwill of 66. There's no gain because there is goodwill. If the fair value of net identifiable assets were greater than the purchase price, then I would have a gain, and I would account for that up here. But we don't. We have a goodwill, so we're going to keep going. To now figure out the differential. What is it? Well, it's going to be the fair value of net identifiable assets plus goodwill, which is the purchase price in this case, purchase price minus book value. And so when you do that, you get this amount. You do fair value of net identifiable assets plus goodwill minus book value to equal 136. Then from there, you allocate that out. How much goes to equipment? Well, it's a $100 difference, and the fair value is greater, so $100 greater, and we'll talk about that in just a second. The deferred tax liability, now the liability is greater, which means you will have a negative amount because you are writing up liabilities, and so you're going to make that negative, just like when you have increased assets, you increase them. If you increase your liabilities, your value goes down. So that's negative. And then goodwill, we know is 66, and it doesn't change at all. Now this column right here is flipping the sign, because remember, if we wrote it up 100, we have to bring it down eventually back to the book value, and it takes 5 years. So I have B20, this $100, negative, divided by 5 for that 5 years. Same thing down here. I have negative this amount, so negative of a negative is a positive, divided by 5 gives me 6. So each year, and then the goodwill we don't do anything to unless it's impaired. And land we don't do unless we sell it or impaired, but there's no land difference here. This 20 and this 6 are going to come in later every year. We're going to amortize that amount each time every year. Now this is your check figure. Why does this say true right here? Because your total differential that you've allocated, the sum of all those parts, does in fact equal your differential up here. And if those don't equal, then you know you've done something wrong or forgotten something. So that answers the fourth question. Now we'll move on to the fifth question.